indication of 3 rate cuts in 2024 has driven market activity over the past week. Investors were quick to increase bets on a quicker loosening of monetary policy. Housing starts released this morning showed a jump of 14.8% month-over-month, with an annualized rate of 1.56 million in November. This is the largest increase in 6 months as word carries of lowering interest rates. Housing starts rose 15% month-over-month and 9% year-over-year to a seasonally adjusted annual rate of 1.56 million, which we just said. Building permits rose 2.5% month-over-month to 1.46 million. We could sure use this extra inventory. Multifamily 5+ under construction remains near record lows. This should help put downward pressure on rents and ultimately inflation. I'm not sure where these multifamily units are being built, but there will be a deluge of units hitting the market. CoreLogic reported that rent prices are now up 2.5% year-over-year in September, which is down 2.6% from the previous report. The latest CPI report showed that shelter costs rose by 6.5%, which is 4% higher than what we are actually seeing due to the lag. The NAHB Housing Market Index, which is consumer confidence, rose 3 points. Oh, wow, they're finally happy about something. To 37. Still in contraction, though. Not all it takes to make these people happy. When they're worried about interest rates, regardless of interest rates, people are buying their houses faster than they can possibly build them, but they're still managed to be bummed out and seem to be all worried about interest rates. Current sales are stable at 40. Future expectations rose 6 points to 45. Traffic rose 3 points to 24. Student loan payments resumed in October, and only 60% of them were made. That is bad. According to the government, that is a pretty hefty percentage of delinquencies and suggests that some of the spending that has been going on is unsustainable. Clearly. And that's going to cause some serious issues on FICO scores and getting people approved. After last week's exceptionally strong improvement, bonds and mortgage rates have leveled off in a fairly sideways pattern. If you had to choose a baseline for the rest of 2023, it would be a sideways pattern to remain intact. Lower risk and lower reward for float lock decisions until further notice. Keep in mind that late December can bring random volatility driven by lighter participation. Baseline is boring when it comes to Thanksgiving week in the second half of December. Things don't always go according to those plans, but bonds are sticking to the holiday trading script. This year, for the third straight day, 10-year yields are headed into after-hours session within 1 basis point of 3.92, and they haven't been far from that on the intraday terms. This is an exceptional absence of volatility and directionality relative to all the movement leading up to last week's Fed activity. As long as it stays that way, bonds are sticking to the script, and there's nothing to see here. Move along, move along. If it doesn't stay that way, we'll cross the analytical bridge when we come to it. So the UMBS 6.0 closed down 5 basis points. The 5.5 improved by 5 basis points. So the 6.0 ended up at 101.39. We're still paying attention to that. So it keeps holding right around that Fibonacci line at the 101.392 as a floor, which has been holding. Keeps testing it a couple times, but it regains back above it. The other thing we have to remember is change is the only thing that's constant. So news came, and this is a kind of a big one to people who pay attention to the economic landscape of the United States over long periods of time. U.S. Steel, which is, I believe, Carnegie's old company, U.S. Steel, the Pittsburgh steel producer that played a role in the nation's industrialization, is being acquired by Nippon Steel in an all-cash deal valued at approximately $14.1 billion. So yet another major American old-school company being bought by foreign investors. But, hey, you know, capitalism. Since peaking in March of 2020, the price of institutional-grade commercial real estate has declined by an average of 22%. The biggest decline has been in office space, which has seen a decline of 35%, followed by apartments, which are down 30%. Over the past year, prices eased 10%, and all property classes lost value except malls, where prices rose slightly. Over the past month, self-storage has performed the worst, dropping by 7.6%. But in terms of things you can control, your mind and how you sell. So definitely check out our blog at wellthatmakessense.com. It's all about the book Influence by Robert Cialdini, which is one of the most amazing books you can ever read as a salesperson or somebody who looks to influence people. This is actually a video series, so you can watch it instead of having to read it. It's all about, the first installment is what is influence, how does it work, and why is it important. So check it out on our sponsor at wellthatmakessense.com.